Brian's not here yet.
No, not yet. I'm emailing him right now.
Was it a 12:45 we were supposed to join?
Yeah, that's what I told everyone.
You know what? I thought you said that, and then for some reason I thought 12:50. I don't know why my mind changed, but I thought you said 15 minutes before, but
Of course, my dogs want to be like super active right now.
Yeah, it always goes. I brought my house phone with me just to keep it next to me, just in case it rings. Of course, it's not going to ring, but as soon as we start the webinar, it'll ring.
Yeah, I put my phone on silent just in case.
Yeah, I can't do it to my house phone. My other phone is. Just odd.
Well, there we go.
All
Hi,
right.
Brian. Can you hear us okay? You're still connecting.
Can you all hear me okay?
Yes.
We can hear you, yes.
Perfect.
Do you have any last minute questions, concerns, anything?
No, I reviewed the questions. Thank you for doing that.
Sure.
My audio visual look good?
Yes.
Perfect.
So I know I didn't outline it on the discussion guide, but I'm going to be doing an intro. So I will obviously introduce everyone. I'm going to do a few housekeeping items like where they can ask questions and talk to each other via the chat. Like I said, I'll review your guys' bios. I'm going to do a quick intro on NextGen and our disclaimer, and then hand the floor over to Scott to start the interview questions.
You still owe me your mailing addresses.
I do. Yes. Okay. I will
Okay.
email that to you right now while we have some time.
Thank you.
Hey, Brian, just quickly, does it matter to you whether I would say commercial real estate or CRE market? Do you have a preference on how you want to address that?
No.
Okay, I'll probably do, I'll start with consumer real estate, obviously, as an intro, and then going forward, I'll just shorten it.
Yeah, that works.
Okay. Just sent that. I'll wait for some attendees to get in and then we'll start.
Okay, just one more quick thing, Brian, and it's not a big deal by any stretch. On my questions, the what can you do with the self-directed IRA and what can you not do? I only bring that up because I was gonna sort of address it in the same answer. So if you want to just ask, what can you do? you don't have to say what you can't do. I will address that in the answer.
Okay, that works.
That just only because I was kind of doing a little practice run myself, and I realized I answered the second question before I got the question.
Sure.
Thank you. I was gonna consider having my Christmas tree as the background, but just wouldn't be a good angle. So
Thankfully, within this tiny apartment, I've had a couple of years to try to figure out where things fit best. So it usually always winds up in my background.
I think it
yeah,
looks good.
My wife likes where she has it, so it stays in the same area. It just would have been too problematic to try to get it in the picture, but I thought it would have been festive.
Okay. It doesn't look like we have any attendees yet. I know we had quite a few people registered. I'm wondering if maybe because we're on a new system, if something happened with the confirmation emails. I mean, I know they went out, and I got my reminders as a panelist. So I don't know what happened there, but we'll just go ahead and get started. We are recording. So whoever doesn't have a chance to make it, they'll still get a copy. We do follow up. Obviously, you guys will get the copy as well, along with the registration list. So you can follow up there as well. So we'll just go ahead, record and get started and go from there. Okay, good afternoon, everybody. Welcome to today's webinar, Commercial Real Estate Investing in a Post-COVID World and How to Do It Through Your IRA, presented by Next Generation and Excelsior Capital. My name is Erica Figueredo. I'm the marketing specialist here at Next Generation. And before we get into today's discussion, I want to first review some housekeeping items, give you some information on our speakers, and tell you a bit about Next Generation. So as always, today's session is being recorded for anyone who didn't have a chance to make it live and for those who wish to watch today's session again. If you are here with us live, it's great to have you. Things may look a little different than they usually do, and that's because we've switched our webinar providers. So we'll now facilitate all of our webinars via Zoom. So with that, everyone joining today's session will be automatically muted for the entirety of the session, but that doesn't mean that we don't want to hear from you. So I'd like everyone just to take a moment to find their Zoom webinar controls on the bottom of the webinar screen. The two main features I want everyone to pay attention to is questions and chat. So if you would like to ask any questions, please use the questions tab, and then the chat is for any other chatter, feedback, etc. That's also where I'd like everyone just to take a moment to introduce yourselves. Let us know where you're from, what you do, and if there's anything specific that you're looking to learn. We'd like to keep this as engaging as possible, so feel free to chat amongst yourselves. So to tell you a bit about our speakers, first and foremost, we have our expert co-host, Brian Adams, the president at Excelsior Capital. In his role, he spearheads the investor relations and capital markets arm of the firm. He has 10 years of experience in real estate private equity. Prior to forming Excelsior Capital, Brian co-founded Preem Properties, an institutional real estate private equity sponsor, in 2010 and provided leadership and direction for the firm in connection with capital markets, investment management, and investor relations. And last but not least, we have our very own Scott Ritchie, who is Next Generation's business development rep. Scott brings a wealth of experience to his role with the sales and marketing team at Next Generation, where he focuses, like I said, on business development for the company. He has more than 10 years of experience in the sales arena, including 7 years in financial services, where he worked extensively with both group and individual retirement plan accounts. Scott has also worked in operations as well as marketing, media, and public relations, all of which serve him well and bring diverse perspectives to his current role with Next Generation. So now to tell you a bit about Next Generation. Next Generation is a custodian and administrator for self-directed retirement plans. So these plans are much like the plans that you would find at a brokerage like Fidelity or Charles Schwab. The only difference between the two being the types of investments that can be held within them. So instead of investing in publicly traded assets like stocks, bonds, mutual funds, ETFs, etc., self-directed IRAs give investors the opportunity to hold alternative investments within a tax-advantaged retirement vehicle. So this includes real estate, like we're talking about today, private equity, notes and loans, cryptocurrency, precious metals, and so much more. These accounts provide a hedge against stock market volatility. They allow investors to diversify their retirement portfolios, and they give them better control over their investment returns. So there's two main arms of our business. The first is our administrative firm, which is headquartered and located in Roseland, New Jersey, Next Generation Services. Next Generation Services handles all of the back-end administration, record keeping, mandatory tax reporting, and transaction support for our client accounts. And Next Generation Trust Company, located and chartered in Sioux Falls, South Dakota, is a licensed and chartered trust company serving as custodian for all of our accounts. So all of our accounts are named with Next Generation Trust Company as custodian and holder of the assets for the benefit of the individual account owner. So now to give you our very necessary disclaimer before I hand things off, Next Generation is not a fiduciary. So we do not provide any financial, legal, or tax advice. So anything on today's webinar is for educational purposes only. Next Generation also does not endorse, recommend, or review the merits of any investment, and any, obviously, like I said, any information provided on today's webinar is for educational purposes only. And if you'd like to learn more about this strategy, you can reach out to one of us at the end where I'll provide everyone's contact information. So to hand the floor over to Scott to get our conversation started. Scott, take it away.
Thank you so much, Erica. And Brian, we really are delighted to have you. We have a lot to cover today, so I just want to dive right in. Obviously, we live in an existence right now that is, some people have determined it as COVID fatigue. Everything is COVID, wall to wall. So with regard to the consumer real estate market, how has COVID shaped it so far?
Yep, Scott, thanks so much for having me. I really appreciate it. That's a fairly broad question. And the way that I like to answer it is by saying that COVID is like a tsunami. You know, depending on how high up in elevation you are, it impacted you differently. So if we kind of go on the early end, obviously retail and hospitality have been really impacted. And I think we're going to get into this later in the conversation, but you know, hospitality may be a place where there are some opportunities today. If you continue to move on, you've probably got industrial and office somewhere in the middle, depending on where you are in that spectrum. I think we will discuss office at some point as well. And then you've got really insulated asset types like industrial, distribution, Amazon warehouses, data centers, self-storage. Those obviously have really experienced quite a boon, as well as single family rental. But again, it's been shifting. To your point, there is a lot of fatigue in the market. It seems like every 6 months, this COVID variant issue kind of crops up and it impacts things differently. Taking a step back and having a broader picture of what's happening in commercial real estate, I mean, frankly, the entire industry is booming right now. The marketplace is frothy. What we're seeing is, you know, not anything that would take anybody by surprise that's been an investor in the space for a while. You know, debt is cheap, inflation is rearing its head, and there's a lot of liquidity in the marketplace, right? So it has to go somewhere. We've really seen cap rates go down fairly dramatically across all food product types over the last 2 years. I think we are going to talk about interest rates in a little bit, but for the time being, it's a very competitive landscape. And from a global perspective, from an institutional investor mindset, commercial real estate in the domestic US is still one of the most, if not the most attractive places to put long-term capital.
Wow. Yeah, that's a lot of information right there. So with that being said, what would be your predictions for the market moving forward?
Well, a lot of it will depend on what happens with interest rates to some extent. That being said, again, I like to take an international perspective on things because I think it really is hard for domestic US investors to understand what's happening. If you're a pension plan or an insurance company in Western Europe, and you look on a global perspective of where you're going to put long-term capital, so things that are over a 10-year time horizon, and your domestic bond portfolio is giving you a 200 basis point negative yield, and you look at the demographics of Western Europe, you look at what's happening in Southeast Asia, and other type of locations, maybe the Middle East, again, US commercial real estate, given what's happened over the last 100 years and where the growth prospects are for the US economy, I think will continue to be a very attractive place to put money to work. And unless interest rates go up dramatically, I think cap rates will continue to decline. I think this money that has been put in the system is going to be very hard to put the brakes on, regardless of what the Fed ends up doing from a tapering perspective. And that money will have to go somewhere. And so I think you'll see cap rates continue to go down as more and more people allocate their liquidity into real assets.
Well, with that being said, then where would you see opportunities for today?
Largely depends on your risk spectrum and your risk appetite, right? So I think I alluded to this earlier in the conversation, but if you're risk on and you feel like we're going to be able to push through COVID over the next 3 to 5 years, there are some deals to be had in hospitality. Hotels have been slow to come back, especially with some of these larger business destinations that typically have these big conference type setups. They are struggling, right? The PPP loan program did save the majority of them from going dark, but there are still some distressed sellers there. And given the Omicron variant popping up recently, I think travel will continue to be muted and subdued. And so I do feel like if you have a lot of liquidity and you have a high risk tolerance and you have a long-term time horizon for your investment dollars, there could be some deals in hospitality. Retail is a little bit of a different animal. I think that COVID really has just accelerated what is a secular shift away from bricks and sticks retail, absent maybe the really high-end experiential retail that we see in some really big time markets. Like I think there was some press today about New York City and the Thanksgiving and holiday tourism traffic happening. Maybe you want to dip your toe in there. But again, it really depends on what your risk appetite is and how long you think you can hold on to things and if you have enough liquidity to do so. Otherwise, it's really competitive. The one interesting place is office. I don't think it's binary. The work from home concept is something that has been bandied about a lot for the last 2 years. My own personal impression and thesis is that it's overblown, that we will see a return to work, but I think there will be winners and losers. A place like Midtown Manhattan or downtown San Francisco or the Loop in Chicago, I think some older product types there, Class B, multi-story office, that is really commodity type product, I think it's really going to struggle. But some of the suburban office names, and if you look at the REIT market as a proxy for what's happening with office, it's rebounded almost 40% from the COVID lows and continues to make fairly good progress. We are seeing leasing momentum, especially within the tech space, which makes you think that these tech leaders, where the industry and the economy as a whole is headed, they believe that office has a place for us in the future. I think the way people use it will be different. And so office is one of those places that, depending on where you are and what you believe on the work from home phenomenon, there may be some deals right now where pricing might be a little bit squishy. to use a technical real estate term. The challenge there is going to be, are you going to be able to find a lender that's willing to go at bat with you to do those type of deals? But honestly, the issue is for taxable investors, right? For individuals and families, who I think are the majority of your listener base, you can go into some of these Amazon, AAA credit rating distribution type deals, or maybe some really solid multifamily and Class A in a really good market like Austin, for instance. But are you really getting the return that would justify your illiquidity and the risk you're taking? Cap rates in the 3s and the 4s, sure, you're going to be safeguarded, but your yield is going to be really tough. And you're going to really have to experience some pretty dramatic cap rate compression to make any real money over the long term there. And given where rates are moving, I think it's going to be a real challenge. So I know it covered a lot of ground there, but that's just kind of how I think about the universe.
Well, Brian, you had a good point with regard to risk. When you're looking at, you have the risk for the investors, but what, with the risk for the companies, when you're looking at, you mentioned the working virtually. If not all of them, I know New York City, you cited as an example, there's a lot of almost like a carousel. It all works together. You need to get people into the city to generate other jobs and keep the economy buzzing. How does that impact the way, how does that risk impact, either the investor or the companies that are, might, rethink their paradigm?
There's an old adage in real estate that demographics are destiny. And when you look at what's been playing out the last few years within specifically the millennial generation, which is now the largest working generational cohort in American history, it's roughly 73 million people. COVID, I think, really allowed people the excuse to make moves that they've been wanting to make for a very long time. The narrative for many people was that this is a generation that includes myself that would be living in Brooklyn, eating avocado toast and living in a 4-story walk up and never having children, never getting married. That was just going to be the way they lived. Clearly, that was not the case, right? Because of the Great Recession in 2008, that family formation phase got pushed back a number of years past the average for most generations in US history. But once they started hitting that, COVID made them realize that we would like to live, work, and play based on cost of living, quality of life, access to single family homes, and access to education for their children. And that's really what's driven, I think, a lot of this demographic shift out of the Northeast, out of Chicago, out of the expensive West Coast into more tax and business friendly environments in secondary markets in the Midwest, as well as the Sun Belt. So when you think about investing in commercial real estate, regardless of the specific asset class, you need warm bodies, right? That's what's going to be driving value. The job growth, population growth, wage growth, those are things that you want to really focus on. And that's where New York, I think, is a real challenge. But a place like Southern Florida and Texas makes a ton of sense, right? That's just where people are moving. So when you think about allocating money, you want to think about the product type and if you believe in office or multifamily moving forward. But I think just as importantly, you want to think about where the jobs are going to be, right? And we're moving towards a knowledge-based economy, a tech-based economy. And when you look at where they're having footprints and planting flags, again, it's kind of more cost-efficient secondary markets in the Midwest and just the Sun Belt in general, especially Tennessee, Texas, and Florida, where there is no state income tax.
Yeah, I'm sure that's attractive to a lot of people. They talk about that. Obviously, as Erica said earlier, we're from New Jersey, and there's always articles about people leaving the state for so-called greener pastures.
Mm-hmm.
They want to keep more of their money. Earlier, you spoke a little bit about inflation. Can you talk a little bit more about inflation and interest rates and how they might impact these types of investments?
Yeah, inflation has been something that's been in the news quite a bit. This transitory inflation that we hear the Fed bandy about. There's been a lot of press coverage about this inflation, which we really haven't experienced for a very long time. I know as an investor myself, I've never experienced true inflation in my lifetime. I'm 39. So it is something we're going to have to contend with right now, whether it is transitory or not. It's now in the zeitgeist, and I think it's part of our investment concept. So for real estate, you hear it pitched as a really good hedge against inflation. It is to an extent, right? And I'm almost speaking against my book here a little bit, but when you hear that, you've got to realize that different asset classes within commercial real estate will behave differently when it comes to an inflationary state. So for instance, hotels, you're basically leasing out that space every day. You can reset pricing when the person checks out at 10 o'clock the next day. Theoretically, you can up the price if you need to. For apartments, it could be every 6 months, every 12 months. When those leases turn over, you can start pushing pricing. For what we do in the industrial flex medical space, our lease terms are typically anywhere from 1 to 2 to 3, maybe even 5 years. So it's not as efficient in fighting inflation because we have a longer term to hold those lease periods until we can uptick inflation. Now, some leases do have what's called a CPI or inflation index type annual bumps that they can experience. There's really a lot of variability there, but that's where I think if you are really worried about inflation, real assets, be they commodities, gold, crypto, if you consider that a real asset, real estate, energy, are historically really good performers in inflationary states because they do have the ability to readjust pricing as we move forward. Interest rates are a different animal and really pernicious for real estate because in a simplistic fashion, if you're buying a piece of commercial real estate and you look at your capital stack, right, which is the debt and the equity you need to bring to the table to close on the asset, say it's 50% debt, 50% equity. Well, if my preferred return and my dividend yield on my equity is 8%, that's my cost of that capital. When I look at the cost of the capital and my debt on that 50% of that capital stack, well, for the last couple of years, it's been 4%, maybe 3%, depending on what type of debt you get and what type of commercial real estate you're buying. So even if interest rates go up 10 bips, 25 bips, 50 bips, 100 bips, it doesn't seem like a lot, but then you're going from 4% to 5%. So what that really does is it just costs more to buy those assets. And that falls through to the investors because it impacts the distribution of the yields that someone like me as a sponsor is able to give to investors. So it's really about readjusting investor expectations. And that's where, you certainly don't want inflation going crazy. Nobody wants a hyperinflationary state. At the same time, it's been such a great time to be a commercial real estate investor because debt has been so cheap. It allows you to buy more commercial real estate for less and obviously improve your yields. So that's where people need to really take that in consideration if the Fed does end up pushing rates in the next 12, 24 months.
Do you see that happening?
I'm not one to prognosticate what the Fed will do. They've been pretty consistent about what they messaged is what they will do. And so when they come out and they say that they expect 3 rate hikes the next 12 months, I think they will do it. They may be really incremental, right? It might almost be more window dressing than it is real in terms of the extent of it. I think a lot of it's going to come down to inflation. If this inflation issue is persistent and they're really worried about it, it's going to really force their hand there, because when you think about the Fed's dual mandate of full employment and the economy, it's going to be something that they're going to have to address. If inflation starts dying down, right? If this whole thing was overblown, supply chain issues are addressed, and Omicron turns out to be kind of a red herring in many ways, then I think they may back down on that a little bit. But considering rates are at zero, I think it's going to be a real challenge. What you have to worry about is the Fed doesn't really have a way to beat deflation. And so they're going to be more comfortable with inflation, which they've been frankly trying to achieve for a number of years now, just haven't been able to. So I think they are going to be really comfortable with it. It's been a long time since somebody at the Fed has to deal with it. So I'm curious how they're going to handle it. But now that Powell got kind of reaffirmed for another couple of years, I do think they will end up having to raise in 2022.
So with regard to commercial real estate investments, how can they be structured? And what maybe are, if you can illustrate a few different types of commercial real estate investments for us.
Yeah, I think the most common formats that you see are a fund vehicle or then a deal by deal syndication type setup, which we're syndicators. And the way that I typically present this is a fund is where you have the capital and you look for investment opportunities. A syndication is where you have investment opportunity, then you look for the capital. It kind of goes back and forth. And my personal opinion is that a fund, which is where you get capital commitments and then you go invest it on behalf of your investors into opportunities, it's a really good fit for big institutional investors, people that want to put $25 to $50 million to work. They don't have the ability to write smaller checks or the ability to do diligence on a one-off opportunity, and they want diversification. A fund is a really good vehicle for that. I think for individuals and families, a fund, especially in real estate, can be problematic. Most people understand the basics of real estate, right? They've been a tenant in a property, in an apartment building, or they've owned their own home. They understand the mechanics there, and they understand locations and some of the basic diligence materials that go into underwriting into an investment. And so what you've typically seen are these fund versus syndications. And what's cool about what's happening now with programs like yourself, podcasts, blogs, webinars, etc., there's more and more education out there to teach people about syndications, about how they're structured, the pros and cons of them. There is no right or wrong here. It's really about what is the right vehicle to solve the problems that you have. And for most of our investors who are high net worth individuals and families, the problems they have are access, yield, and tax benefits. Those are the things that they're trying to achieve. And for those three issues, a syndication is a really good fit, in my opinion.
Well, you had just touched on, glossed over, I should say, the pros and the cons. Can you kind of expand a little on that for syndications?
So for a syndication, the con is there's no diversification, right? I come to you with an opportunity. It is a medical office building in Fort Lauderdale, Florida. That's great, right? It's an attractive opportunity. It's a good market, et cetera. And you invest into that deal. If something were to happen, right? A hurricane hits Fort Lauderdale. The deal doesn't work out like we all hope. One of the main tenants goes bankrupt. Well, you have an exposure to that property, right? You don't have any diversification. There's no cross collateralization with other opportunities. And so you miss out on that risk barrier. The flip side is you can really get comfortable with that one opportunity, right? And you can say, my grandmother lives right around the corner. I grew up there. I'm a big believer in South Florida. I see the stories. I understand what's happening. I love the tenant base here. I like the risk profile, and the timing's really good. I just cashed out of my crypto position. I've had a great run in the market. I'm cash heavy and liquid. I want to put it to work now. The timing is right for me now. And that's where the syndication can work. For a fund, it's a blind pool. So I come and pitch you with an idea or a concept of what I'm going to do with the money, but you don't really have specifics about where I'm going to put it. There are typically no buildings already in the portfolio. And so you don't have that line of sight directly into it. And also, people get confused, and I think it can be a bit clunky in terms of this capital call structure, where if you commit $100 into a fund, I'm going to call that capital over 3 years, right? So $33 year one, $33 year two, $33 year three. I'm then going to deploy that capital over time, and then it will all come back, hopefully, in years 7, 8, 9, and 10. Whereas a syndication, we buy that property, within 30 days, I'm sending you checks, right? It's just a different type of experience. And I think, frankly, with what's going on in terms of technology, diligence, investor relations, and what's prop tech is kind of a general idea here, more and more people are getting comfortable with participating in a syndication and able to find sponsors like myself that can solve their individual problems. So there are there's more minutia, obviously, but those are the high level pros and cons.
So since you were just talking about commercial real estate investors, what are some of the due diligence best practices for them? And, what questions will they typically ask? What questions should they be asking when they're looking to invest in commercial real estate?
Yeah, this is a great question. And again, to reference what's happening right now over the last 2 or 3 years, that really wasn't the case when I got into the business 11 years ago. You can educate yourself about, let's say, medical office is a place that we invest. You can go on podcasts, webinars, books, Audible, Amazon, etc. And you can, if you have the time, for free. Now you got to give up your time, but for probably not a ton of money outlay, you can really educate yourself about medical office buildings, how they work, how the underwriting is, what you have to be worried about, the pros and the cons, etc. And you can get up to speed there. And frankly, like ourselves, a lot of sponsors these days, we're doing frequently asked questions. We're doing webinars about, how to diligence opportunities. We're providing you with all this information. And so I won't kind of go too in depth there because you can get really technical really quickly. I think the better question is, and where I've seen really savvy investors ask is, okay, let's kind of assume that I believe in the pitch. Like I believe in this medical office building in Fort Lauderdale. And I like you, Brian, and I trust you. I like your positioning in the world. The right questions are, well, what is the experience going to be for me as an investor? Like I meet you, we have a phone call, I do the diligence on the opportunity, I move forward with the investment, I wire the money, we close the deal. What happens next? And then on a daily, weekly, monthly, quarterly, annual basis, what are my expectations as an investor going to be? What are the investor relations? What are the communications? What is the reporting? What does my staff look like? What does my internal technology infrastructure look like? I think those are questions that a lot of people don't ask as investors, as prospective investors, because they just don't think about the business that we're in. Obviously, there's the deals, right? The individual investments, that's the real estate part of it. But to be a sponsor these days, you are really running a small business. I mean, a lot of my time is not really spent underwriting opportunities, right? I've got acquisitions associates that's all they do. A lot of my time is making sure the machine is moving forward correctly, that I have the right staff internally, that a reporting is best in class, that the investor portal has everything that should be included in it, that we're doing everything we can in terms of giving people the transparency into what's happening with their investments. That's where I spend a lot of my time. And I just don't think a lot of people ask the questions, okay, you are investing in real estate, but you're also investing into a small business. And small businesses in America typically fail, right? I think it's like 85% fail within the first 12 months. So talk to me more about how your business is set up, because the deal is going to work or not, right? We all hope it does. We're going to kind of move forward there. But I think the bigger risk oftentimes is your company going to blow up, right? Do you have the right people in place? Who are your other C-suite executives that are on your bench that are going to be able to help me have an outstanding experience as an investor? I think those are the right questions. And frankly, what you see oftentimes within the LinkedIn world, there are people who are saying they're sponsors, saying they're operators, saying they're sourcing deals. But in reality, what they're doing is maybe just raising money to put to work with somebody else, right? They're an allocator looking for a sponsor operator, or maybe they do some deals, but their real primary business is in coaching or consulting or advising, or they're selling a class about how to underwrite deals or how to raise money. I don't think that's really probably who you want as a fiduciary of your capital. You want somebody who's really focused on running this business and being a professional investor. And so those are the type of questions that I would encourage people to ask.
Well, that's really great information, Brian. You've really answered a lot of the questions I had. And when at the conclusion of this webinar, the people who are in attendance will have the opportunity to ask you any additional questions. I want to know, did you have any questions to ask me?
I've got some hard ones for you, Scott.
Okay.
It is interesting. We more and more people have been investing with us through their IRA. It was a space I was not really familiar with up until a couple of years ago, just because I don't think a lot of people knew that they could invest in real estate through that setup. So could you maybe kind of high level explain what a self-directed IRA is and what the benefits are for investors who may want to leverage it to participate in commercial real estate offerings?
Yeah, sure. Simply a self-directed IRA is an IRA, just like any other IRA in the marketplace. And what I mean by that is it's no different, like the rules that govern the IRA itself from an investment point of view, like a contribution, et cetera. It's all the same. But what a self-directed IRA is considered to be is a non-traditional retirement account, and it allows individuals to invest in areas that they already understand. Markets that we call the alternative asset universe. So it's not stocks, it's not bonds, not mutual funds or ETFs. It's an alternative marketplace that people generally don't invest in. It's only, and the percentage varies, but it's a very small percent of the entire IRA universe that invests in self-directed IRAs. But it's something that's been around since, I believe, the inception of ERISA. So back in the mid 1970s, you've had the ability to invest using a self-directed IRA, and it's for investors who are comfortable, controlling their own retirement accounts, and they're savvy investors. Sometimes they've come to one of these webinars, they've gotten information, it's piqued their interest, and they thought it's the right vehicle for them. So, that's essentially what a self-directed IRA is, and that's what maybe one of our investors who've never done it or has done it and wants to make an additional investment should consider.
And I know there are kind of some regulations around what you can or can't do with these IRA funds. Could you maybe provide a little bit of detail about what you can do and what you can't do?
Yeah, absolutely. A lot of times it's easier to say what you can't do because it's less than what you can do. What you can't do is in terms of when you're investing using a self-directed IRA, you can't invest in life insurance. You can't invest in collectibles, which in, liquor, wine, coins, et cetera. Those things you're not permitted to. Otherwise, there's almost an abundant opportunity to invest in a lot of things. Traditional or typical, I shouldn't say traditional, typical investments would include real estate, commercial real estate, residential real estate. In the residential marketplace, it could be a buy and hold, it could be a fix and flip. You can invest in mortgage notes or any other kind of promissory notes. Cryptocurrency, as you referenced when you were speaking, is becoming a big thing for people to invest in. That marketplace is big. Precious metals, not coins. Precious metals is something else that people can invest in. You can lend money using your IRA. So it really is practically limitless. So there's a lot of opportunity to invest in the alternative asset universe using a self-directed IRA.
And if I wanted to move forward with using my IRA to invest in an opportunity, what does the process and timeline look like?
Well, the process is relatively simple. We have like a 3-step process here at Next Generation. What we do is, first off, before anything gets going, we need an application. So we'll have a conference with someone, provide a little education, do a little fact finding. We'll get an application from them once they're sure they want to move forward with an account. Once that application is received and the account is open, we hand off to our transaction team. We have 2 teams here at Next Generation. We have a sales and marketing team and a transaction team. When we hand off to our transaction team then would work with the new account holder in getting their account funded, depending on whether they're going to bring over a transfer from another custodian, a direct rollover from a 401k, an old 401k plan. Wherever the money's coming from, our transaction team will work with them in getting it moved over to Next Generation. Then once that is moved over to us, then we're going to work with the individual in making the investment. So the investment's the final stage in the process. Our timeline, we say 2 to 8 weeks. I always say the 2-week is the perfect world. Extremely unlikely it's going to happen. All the I's get dotted, all the T's get crossed. Everything goes smooth as pie. It's usually, I'd say, a 3 to 4 week is a normal process. the big lag there is where the money's coming from. The other custodian sometimes, even in this day and age, will sometimes mail a check. You figure everybody be wiring money or ACH, but there are big wirehouses now that would rather mail a check. And especially with COVID, the mail does not move too expeditiously these days. So we say 2 to 8 weeks, but it's generally 3 to 4 weeks is our kind of sweet spot in getting an account open, funded, and then making an investment.
And to that point, what documentation is required in order to get this done?
Well, it's a great question because there's always documentation needed. From an internal point of view, we require a bi-direction letter. We're going to require a private placement instruction letter, a private placement advisory notice. We're going to figure out the method of the payment or the transaction, and whether or not it's going to be wire, ACH, how the money is coming to us. So those are documents that we're going to require internally. As well as supporting documents, we're going to need the operating agreement for the LLC. We're also going to look at the certificate of good standing, any kind of articles of formation. We're going to need a signed subscription agreement, private placement memorandum as well. So those documents are what we're going to need when we're dealing with people who make investments into their IRA. The way the IRA was going to get paid, they make the investment, the money flows as a custodian for us. The money will make the investment. The investment comes back into the IRA, and then the IRA holds that money, and that is essentially the return on the investment for whatever's mean. That's the way the capital flow tends to work. So that's sort of how that's how it works for us in making the investment. When you're like the rent that's paid or is essentially the return on the investment.
Okay,
So,
thank you.
Yeah. So if you have no other questions for me, I guess we'll turn it back over to Erica, to our moderator.
Thanks, guys. That was a really great conversation. I don't think we have any questions at this time, but I do just want to hit a couple of points that I think we might have missed. And then we'll get into some polling as we wrap up. So there's just a few questions that we have for our audience as a way for us to get to know you better, where you may stand right now and what you're interested in doing in the future. So before we get to that, Scott, would you mind reviewing prohibited transactions? I think that was something that we wanted to touch on.
Oh yeah.
Specifically with the question, like
yes.
what you can't do.
Yeah, that's actually very important to address on the prohibited transaction. There's 3 types of prohibited transactions. You don't want to engage in a prohibited transaction. A prohibited transaction is engaging in practice with a disqualified person. There's 3 kinds of prohibited transactions. There's a per se prohibited transaction, a self-dealing prohibited transaction, and the other transaction is I'll come back to that in a second. The prohibited transaction, that when you're dealing with a disqualified person, we generally say they're ascendants or descendants. So, fathers, parents, grandparents, children. Ironically enough, brothers and sisters are not considered disqualified people. Fiduciaries are also considered disqualified people. And other financial advisors, accountants, business partners. So there's a number of different people that can be considered disqualified. So when you're dealing with a prohibited transaction, that's the one thing you want to avoid doing is a prohibited transaction, because that would lead to the IRS deeming your IRA losing its status, and then it would be cause for distribution, which could lead to penalties and fines. And I'm sorry, I'm just drawing a complete blank on the last one. What did I say? I said it's a per se, self-dealing, and Erica popped me in.
Extension of credit.
Extension of credit. Thank you. Oh my goodness.
2 out of 3 is not bad, Scott. You get in the Hall of Fame on those.
2 or 3. Yeah. I don't know why the extension of credit just left my mind, so I apologize for that. But those are the three kinds of prohibited transactions that you would like to avoid. And we, as our role providing the education, is to help you avoid those. So we kind of look at the investment and we can have an idea whether or not it looks like a prohibited transaction may occur. And that's the transaction team, and that's their level of expertise, where they have that they can see the information and they can make a determination on whether they think it would work or not. But they're checking more for IRS guidelines, not for legality. So that's just important to address. I'm sorry I missed that, Erica. Thank you for pointing
That's
that out.
okay. The only question, actually, no, we just got in another question. So Dennis would like you to elaborate on extension of credit.
Would like me to
Yes.
let me see if I can give a good example. I'm trying to think of a good example of an extension of credit. Let's see. Extension of credit is basically creating a loan to yourself for the IRA. So that's just something that's not permitted. You can't loan yourself money in an IRA. So that'd be an example of an extension of credit.
Another good example of that, I think, is especially with respect to real estate investments. Typically, if you're involved in like a direct real estate investment, and let's say you need money to make repairs, refurbish, whatever it may be, and the investor would, let's say, open a credit card for that purpose, that would be considered a prohibited transaction via extension of credit. So you wouldn't be able to guarantee any loan to yourself personally. The only way that you'd be able to do that if you needed some sort of leverage to cover those expenses would be through a non-recourse loan. I know that gets kind of complicated. A lot of these prohibited transactions are gray area. So for that, we would recommend consulting with an ERISA attorney to be able to determine if that's something, that would work or would be considered a prohibited transaction. But also we have a really great white paper available on our website strictly on prohibited transactions. So it goes over a lot of really great examples for each of the types of prohibited transactions. So that's obviously available on our website, www.nextgenerationtrust.com. And on our top navigation, it's under information and education, and then under white papers. So with that being said, we had one other question, which I don't think we're going to get to today, but I did want to just pop it in because I just wanted to make a quick note about it. Dennis also would like to know if Excelsior has any open investments and are they funds or syndicated deals? So that is the type of question that we're not going to get into on any of these types of webinars. Obviously, what we're presenting today is for educational purposes only, but you will have the opportunity to connect with either us or Brian at Excelsior outside of the webinar if you are interested in exploring this opportunity further. So with that being said, we'll get into some of our polling. Like I said, these are just a few questions for us to be able to get to know you and what you're interested in and where things are currently right now. I apologize. I do live at home and I'm working from home, so I have dogs. Unfortunately, he's barking right now, but I'm going to get myself on mute in just a second as I serve these polls. So the first question that we'd like to ask is, do you have any existing retirement and or savings accounts? So I'm going to launch that poll now and give you guys a few seconds to answer. Looks like we've got a healthy mix between traditional IRA or Roth IRA I know a lot of you probably have 401k plans with your current employers, so that's a good mix. And then a savings incentive match plan for employees of small employers, which is also a simple. Okay. I'll close that one out and share the results. And we'll move on. So our next question, as it relates to accounts and retirement accounts, and this is if you're comfortable sharing, it's not required. What is your balance of those retirement accounts, or what would you be interested in investing? Okay. And here we go. So 50K to 100K. There's definitely a lot that you can do with that. And finally, I know that today's webinar is geared towards commercial real estate investing, but we do want to just get an idea if you have any interest elsewhere. So what types of investments are you interested in? Okay. Give it a few more seconds. Close it out. And it looks like the majority are interested in real estate, which is probably why you're here today, or private equity and hard money lending. Okay, so with that being said, that concludes today's presentation. Brian, thank you again for joining. There was a lot of great information shared today. As always, Scott, thank you. And we hope to see you on the next one. Have a great day, everyone.
Thank you all.
Thank you, Brian. Thank you, Erica.